A big story on India tonight. Most Indian investors know that historically, December becomes a favorable month when it comes to market returns. But it doesn't seem like it is this December of 2022. The Nifty was around 18,800 at the start of the month of December. Now, 3 weeks later into the month, the benchmark index is down. It's down almost 700 points. So is this because of COVID concerns, of rising cases of COVID infections? Or are Indian markets taking cues from global peers? What happened to the Indian outperformance story? We're going to discuss all of that, but here's a set of interesting numbers that's coming in from the US. The economy there has grown 3.2% in the third quarter, and this, placed against the market expectation of 2.9%, means that the US economy has shown resilience. So that entire talk about recession in the US could wait, but the US stock markets have opened in the red. Jobless claims now stand at 216,000 as against the estimate of 222,000. So here's a lowdown on the Indian markets before we deep dive, just to understand the numbers that we're seeing, why Indian markets are in the grip of the bears all of a sudden, it would seem, in the month of December. And for that, let's bring in my colleague Anisha Jain. She's joining us to walk us through today's highlights in trade. Anisha, at the end of trade this Thursday, how did the markets look?
Well, a very choppy session coming in for the Indian markets yet again. The markets drifted lower the mark of 18,100 on an intraday basis, though by the end of the session, we managed to recover almost 100 points from the lowest level and ended just around that 18,120 mark. Having said that, it was quite a broad-based sell-off, and I say that because all the sectors went home with a bit of a red tick. Even if you look at the broader markets, that is where a lot of carnage was, because the mid-cap index was down almost 0.9%. You also had the small-cap index going home with a cut of around 1.5%, and even if you look at the advanced decline ratio, very strongly tilted in favor of declines, almost 1,700 stocks declining to 300 stocks advancing, and that will tell you the kind of the market breadth weakness that we saw in the markets today. Separately, if you look at the stock-specific action and sector-specific action, while IT and pharma were the one that led the least, it was PSU banking space that was coming under pressure. Realty, metal, auto, they were all down in trading session, and the bank Nifty is also showing quite a bit of sign of weakness. It fell almost 500 points from the highest point and ended just around that 42,500 bank. The cut today was led by Bandhan Bank, so that was coming under pressure, plus IDFC First did not have a great day. PSU banking names that were coming under pressure include names like Union Bank as well as PSB. In terms of stock-specific action, what managed to buck the trend today was Ajanta Pharma, despite that block deal happening. You also had REC that managed to hold into the green after Jeffries and Chriswood put it in their long-only portfolio. So some spots of green, but definitely a day of red.
A day of red, but will red persist in the Indian markets? That's the question. And now looking at that US GDP data, we need to put that in context as well. To discuss all these factors that are weighing in on market sentiment, let's connect with Jeff Dennis. He's the independent emerging markets commentator, joining us on this edition of India Tonight, as many other nights. And Mahandesh Sabarad is also joining us. He too is an independent market expert. Great to have you both, gentlemen. Jeff, to put US GDP in perspective, it's gone above 3%. Does this square the pitch as far as the US Fed's decision about rate hikes is concerned?
No, I don't think it makes much difference for a couple of reasons. First of all, it's an annualized number. So basically GDP growth for the quarter itself went up by 0.1 only, rounded up. And obviously when you annualize it, you get a number like 3.2 up from 2.9. But also it's history. That was data for the third quarter. I think it's going to be much more likely the markets will focus eventually pretty soon, I think, on what Q4 and Q1 and Q2 look like. Most people expect there to be a recession, if there is going to be one, in early 2023. So I think arguably you could make the case that the stronger the economy was in the third quarter, the slower it might be in Q4 and Q1. So once we get through this particular daily response here, I think it actually doesn't alter the bull market case for next year at all. I think it's just that it was a bit of a surprise. And at the moment, unfortunately, with the Fed tightening, good news is bad news.
Yes, it certainly is. Mahandesh, do put this in context from your perspective. Do you agree with what Jeff says? We speak about the resilience of the Indian economy, but it's not like we haven't been seeing it in the US, and now there is data to prove that. Even with recessionary trends building up, showing in that macro data, there has been resilience in the American economy, and it's shown over 3% growth now. Will that mean FIIs will exit India for now, you think?
No, I don't think FIIs will exit India. In fact, if you'll notice the market's performance for the past 3 months, compare the R index, whether it be Sensex or Nifty, let's say with Dow or S&P 500, or even FTSE and Hang Seng, then over the last 3 months, I believe we are slightly underperforming these markets. That's one reason alone which can drive investments from FIIs into India. So that there is other reason as well. India is the growth haven for the world, in the sense that you tend to find stocks. There are better choices in India for stocks which have potentially large growth and relatively safe in terms of size as well. In terms of some of the Indian companies are pretty large. All these factors augur really well for some of the FIIs to set their investment targets for India or investment allocations for India. So I don't see much of a dip coming in from the FIIs. The only reason that will discourage FII investments is if something happens in the forex markets. Let's say the rupee depreciates far too much, and that's got to do with the rate actions that we will see in the subsequent months. The relative rate actions, I would say, between RBI and the US Fed. So unless you have volatile forex, you wouldn't see much of a dip in terms of FII flows coming to India.
Do you reckon that there would be volatility in the forex market going ahead? Meanwhile, it's not like globally the markets have been shining through, but India has held its own so far, notwithstanding whatever's happening between the US dollar and the Indian currency. Do you reckon this is the end of the bull run, or is this a temporary overhang that we're seeing in the Indian markets right now?
I believe that the bull run is not really over. I think let me come back to the remark I made about the Indian markets underperforming the global markets for the past 3 months. So that tells you that this underperformance makes it a little safer from a purely volatility perspective. And you also have now an upcoming year where probably you will find stable interest rates. You will have a policy thrust coming in via the budget that will be announced in February. You will see corporate earnings becoming better, given that you are now virtually out of the entire COVID disruptions that you had seen for the past 2 years. So the base effect is gone. And thankfully, we also have stable and better commodity prices now to look forward to.
Jeff, what's your perception as far as emerging markets and India in particular goes? Because we've had a reasonably good run all the way into December. The Nifty now disappointing in the Santa month. Over the last 3 weeks, the index has lost 700 points. We are seeing that amount of volatility right now. What do you put it down to? Will this downtrend, you think, persist, or is this something that will pass?
Let me make a couple of points. First of all, to agree with my colleague here. China's actually outperformed India in the last 3 months by 800 basis points, according to the MSCI data in dollars. And that reflects, I think, in the short term, a little bit of optimism about China because of the efforts they're making to deal with the property crisis, and obviously perhaps an end to the heavy selling that you've seen for a long time in China. But I would agree that I think the outlook for China over the next 6 to 12 months is much better than it is for India, because frankly, one of the risks to markets in 2023 is China fails to get COVID under control, and you see the whole thing sweeping through the economy, causing a major disruption to growth. Now, that's one thing. The other thing is part of my narrative, which you heard from me before, for 2023, bond yields have peaked, equities have bottomed, the dollar has peaked, is that you will get further weakness in the dollar. Dollar's already down about 9% on its effective index, trade-weighted index since September. And I think if the dollar continues to drift lower, that's going to be very good for emerging markets. So I see a much better year. Well, I see rephrase that, a good year, a very good year for emerging markets next year, driven partly by the dollar, driven by the fact that I think the downturn in the US economy is priced in now. And I think India, having seen a bit of underperformance here in the last 3 months, will be an outperformer against the background where China's still got a lot of its own internal issues to tackle, particularly the lightly wide spread of COVID now that they've abandoned their zero COVID policy.
And that could create other kinds of problems, and India would have to contend with those. And we are talking about what the centre is planning, what the states are trying to do to control the spread of infections. Mahantesh, do you think this could be a problem going ahead right now? Because so much has been said about how you can't afford to miss the rally that's in the Indian markets. Others say, hold on for the moment, wait for some dust to settle, whether it's COVID infections, it's the Russia-Ukraine war, the global crude oil prices, the European economy growth plans, and indeed the Chinese recovery story as well. So how do you think the Indian market is going to pan out in 2023, at least in the opening months of the year?
So let's look at the basics of fundamentals. The corporate earnings that drive the markets higher, as far as India is concerned, is still stable. In fact, I would reckon that the corporate earnings are on an uptrend. Given the fact that you have stable interests and given the fact that commodity prices are now prevailing lower, that's something which drives corporate earnings to a large extent. Of course, there's the only problem that they are facing right now with that demand surge that should accompany any pandemic recovery has not been qualitatively better for most of the companies. That demand surge, if it comes in, aided, let's say, by the policy decisions that come out of the union budget, we should perhaps see better corporate earnings, therefore, in the next year. That should drive the market, according to me, higher. And we also have a plethora of companies that have come to the Indian market. In the last 3 odd years, if I'm right, we have had close to 120 odd companies, 115 odd companies hitting the market with their IPOs. Now, that's a big choice. Some of these IPOs have been large. Take the example of LIC, for example. Some of these have been qualitatively very good as well. So if that is the case, the choice has widened for equity investors in India, and that should also drive the indices qualitatively better, because indices finally revolve around good companies, correct? So if you have good companies performing better and better, they get included into the index. The weaker ones are weeded out. This phenomenon will kind of accelerate in the coming year, given the huge spate of IPOs that we have seen, who are qualitatively better, who are in terms of size as well as large. So I believe that we should be seeing the year better as far as India is concerned.
All right, fair enough. Both of you gentlemen are pretty sure about India's relative outperformance when it comes to the rest of the world. And we'll continue tracking that story. Both of you have pointed out global and local factors that would help the growth within the equity markets, despite the kind of downtrend that we are seeing in the month of December. That Santa rally is nowhere in sight, but we'll keep tracking that. Thanks very much, both Jeff and Mahantesh, for joining us on India Tonight.